Welcome to everything you need to know to get started in making life insurance an asset that works for you rather than solely an annoying necessity that you wish you didn't have to pay for. My name is Daniel, and I'm with Protos Wealth Concepts, an educational service that helps people understand life insurance and helps people take control of their finances with time-tested strategies, as well as some techniques you may have never been introduced to before. I'm excited to share this with you, and I hope that you get a lot out of this. In this presentation, you will learn about the different types of life insurance and different strategies you can use to improve your coverage and your finances. By the end of this presentation, you will know which types of insurance are best for your situation and how to plan ahead for the future. You will feel confident in making the best decision for you and your family. I encourage folks to talk to me about setting up a policy that is custom made for them, not a cookie-cutter approach. And no, it's not more expensive to do so. It just takes more time for the agent to set up and explain. But this is what you want, isn't it? To have the best plan for your specific needs and goals, and to be educated in how to use it to your greatest advantage. Most of the time, the best policy consists of a blend of convertible term coverage with whole life coverage. And if you don't know what that is, don't worry. You'll have a solid grasp on that shortly. I often talk to people who are wondering why their term life insurance is becoming so expensive and they haven't planned ahead for coverage in the future. They were told to buy term and invest the difference. And now they are left with ever-increasing rates for term coverage and wish they had built up a whole life policy all this time. And by increasing rates, I'm talking about hundreds to thousands per month for their term coverage as they age. They wish that someone had come along and truly educated them on what they were buying, that someone had shown them how to use life insurance as one of their greatest assets rather than just an annoying necessity of life. So my encouragement to you is be prudent. Start as soon as possible. There are no cookie-cutter approaches, but a custom design can save you a lot of money and protect you even better in the long term. Don't wait until your 30s or 40s to figure out life insurance. The sooner you start, the better. If you're like I was before learning these concepts, then you have no clue what types of life insurance there are and which is best for your situation. Let me help you out. Everyone's needs are different, but there are some best practices to be aware of when deciding what is right for you. Take your time educating yourself, but at the end of the day, don't neglect getting appropriate coverage. Appropriate life insurance coverage is foundational to your financial freedom. Now, there are two basic kinds of life insurance, term and permanent. Term can be convertible, meaning that you have the option to convert it into permanent coverage at some point in the future. Permanent can be whole life or universal life. Universal life has various subcategories as well. In my opinion, universal life policies introduce too much risk and should be viewed as an investment rather than as guaranteed life insurance. Therefore, I do not recommend this for my friends, family, and clients. And in general, I'll refer to whole life insurance as permanent insurance. So let's get into it. Term insurance is essentially renting coverage at a lower cost for a specified period of time. So renting a car is less expensive than buying a car, but you wouldn't do it forever if you wanted to keep that car forever. It's the same with insurance. The problem with term insurance is that it gets prohibitively expensive with increasing age and decreasing health status. So the older that you get, or the sicker that you get, the more expensive your term insurance gets, until at some point you can't even afford to have term insurance, or perhaps no insurance company would even continue to insure you because you're too great a risk of dying, either because of age or because of your health status. So term insurance is very helpful for when you're young and healthy, when you need to just rent that insurance to cover your bases best as you possibly can. Now, what a lot of people don't know is that term insurance can be set up as convertible as well. Convertible term is term insurance that can be converted to whole life within a specified time frame. It allows you to guarantee that your term coverage can be converted to permanent coverage and lock in your current rating. So when you initially get term coverage, you get a certain rating based on your age and your health status. And if you decide to go for a longer period of time, like say 20 or 30 years, you can lock in that rate and lock in the rating status that you obtained for that entire period of time. But when that time period is up, you're not able to just renew at that rate. You're going to have to requalify. If, however, you had purchased convertible term, you have the option along the way, as you are financially able, to convert some of that guaranteed insurance into a permanent or whole life policy. So this gives you an advantage that you can use in the future, especially should your health status change. Because let's say that you were beginning to age and you wanted to renew your convertible term, but you found out that now with your new diagnosis, you're no longer qualified to get a new term. Well, you can convert that term into permanent policy instead and utilize that. So it's very advantageous and oftentimes not much more expensive to simply get convertible term rather than non-convertible term. Now, let's talk about whole life insurance. Whole life insurance is buying permanent coverage through specified yearly premiums. So let's say that you want $100,000 worth of coverage. You're going to divide that $100,000 of coverage, or what we call death benefit, over a specified amount of years that you're going to pay for that. And those premiums are spread out over that amount of time so that you eventually purchase that entire coverage. Also, this type of policy accumulates cash value like a bank account. Now, some may say that the downside or the difference here is that term is cheap and whole life is expensive. But it's all about your perspective. Again, renting a car is cheaper than buying a car. But do you want to have the car at the end of the day? Do you want to own the car for the rest of your life? Or do you want to have to give up that car at some point? No matter how much money you put into renting that car, by the end of your rental term, you're going to have to give it up. And you don't get to keep any of the money that you had accumulated or paid for your coverage. So there's the difference there. Now, there are other types like we mentioned, such as universal life, variable life, indexed universal life. The problem is these are linked to and dependent upon the performance of investments. So the goal with these types of policies is to shift risk from the insurance company onto the policyholder. So the policyholder, in other words, takes on more risk by using one of these policies. And the potential upside is that they may gain more cash value and grow their policy faster because they're connecting it to some sort of stock market index that may grow a lot. The problem is it introduces a lot of risk because the stock market goes up and it goes down. There's a lack of guarantees and safety, meaning that poor performance of the market could put policyholders at risk of substantially higher premiums and even risk of lapsing on their entire policy. And that is the last thing that you want to do with your life insurance, because life insurance should be a foundational guarantee, not something that is introduced to a lot of risk. So, the types of policies like these, like the variable and universal and IULs, indexed universal life, they have not successfully stood the test of time like whole life has. Whole life has been around for centuries now, and these newer types of policies have been around for perhaps a few decades at most. So they are not endorsed by Protos Wealth Concepts. Some people utilize them, and it's possible that you could obtain some benefit for them. But for our purposes and our discussion, I do not recommend them as a life insurance product solely. Perhaps more to be seen as an investment with inherent risk. So let's take a look here at term costs for John Smith. This is our fictional character at age 35. And let's say that he's got a 10-year term for $500,000 worth of coverage. So his yearly premium, or his cost for his insurance, is $330. Boy, that's cheap. You mean I can get $500,000 worth of coverage for only $330 a year? Well, what's going to happen at the end of the 10-year term? You're going to have to purchase another 10-year term or even longer, and it's going to be more expensive at that point because you're going to be older, and God forbid you have some sort of a diagnosis or an illness that now perhaps you've become uninsurable, or your rates are going to become very expensive. That's the downside to taking on a short term, like a 10-year term, because by the end of that 10 years, there's a chance that you could be sicker and uninsurable. So let's say that you wanted to take the maximum, or let's say you had the option to have a 30-year term, to have that $500,000 for 30 whole years, and it would cost you $730 a year. So it's going to cost you more than the 10-year term amount, but you're guaranteed that coverage for 30 years. And that's a pretty good option because that covers your bases for 30 whole years in case you get sick. Plus, you're going to get older in that 30-year time frame. Now, let's take a look to see if John Smith was looking for coverage, but he was already 55 years of age. You can see now that his 10-year term went up to $1,325 a year, and his 20-year term was at $2,045 a year. And in fact, he's not even given the option for a 30-year term because for John, his coverage was only guaranteed to age 75. So when he turns 75, what is he going to do? If he doesn't have some sort of permanent life insurance coverage, then he will not have any life insurance at that point. And if he's got nothing else saved away, then he's got nothing to cover his bases. And unfortunately, this is the place that a lot of people are in today because they were told to simply buy term and invest the difference, but they never did invest the difference. So here's a myth that I hear commonly. It's an objection that I hear about whole life. They say, whole life insurance is a waste. You don't get to keep your cash value when you die, just your death benefit. So to clarify, the death benefit is the amount of coverage that you have should you die. If you had $1 million of death benefit and you died, your beneficiary would get $1 million tax-free. Now, your cash value is the amount of death benefit that you have access to early. So the reality is that when you pass, your beneficiaries receive the full death benefit, which is what you are actually paying for in your premiums. The cash value is not something that you're paying for in your premiums. It's simply tangible access to your death benefit before you pass. It's a benefit that you have should you need access to your money. So let's say that you had a stock market investment and you had a total of $100,000 that you have invested, that it's grown to $300,000, but they tell you that you don't have access to any of that money without a huge penalty or a fine or perhaps a loss in the value of your investment. Well, essentially, you don't have any tangible access to your investment. So life insurance can be seen as this product that allows you to get a large amount of coverage that you're paying for over time, but also gives you some access to that in case you need it. So whole life is really like a savings account that multiplies in value when you pass away. So here's another analogy to think of. Imagine you paid for your house for 10 years and still had 20 years of payments remaining on your mortgage, but you passed away during that time. Now, normally, your family would still owe the mortgage on the house. But if you view this like life insurance, when you pass away, you keep the whole house fully paid for. Now, you would think, well, that's great. I don't have to pay the rest of my mortgage. Would you then demand your money back from the first 10 years of payments? No, of course not. Yet people are trying to make this idea that you're losing and wasting money with whole life insurance. So you would just realize that your family just inherited a house worth 3 times what you'd paid into it. That's a great deal. That's a great investment. You see, whole life shouldn't be thought of as an investment necessarily, but it's thought of something that will cover you in the worst case scenario. So it's nice to have coverage and term coverage when you're young. In case you do pass, your family is able to get a lot of coverage for a very inexpensive cost. But in the long run, you want to be able to maintain coverage as you age so that you're able to actually pass down wealth tax-free to your beneficiaries. And we'll talk about this strategy soon of how whole life can also be a vehicle for cash accumulation and generational wealth. So let's take a quick look at a whole life policy. And if you see at the top here, it says Whole Life 121. What this is it's a whole life policy that is paid up until age 121, essentially guaranteeing that the person has passed on by the time that they've fully paid for their policy, because most people don't live to 121 years old. And you'll see here that the initial death benefit is $500,000. So that's what coverage that you are purchasing right here is $500,000, starting at age 35. So his annual premium would be $5,835. Now you may think, wow, that's way more expensive than term. Well, yes, it is more expensive, but let's see what happens with that money that you're putting into it. You can see that by year 5, you've put in $29,000, $175, and you still have $500,000 worth of death benefit. And you'll also see a cash value right here, which means that in year 5, you have access to $13,000 of that $13,000 of that $500,000 death benefit, which you can utilize for various things. It could be emergencies or opportunities, car payments, things like that. You have access to that cash value should you need it. And one thing that you'll notice right off the bat is that you have over here this guaranteed scale and a non-guaranteed scale. These are contractual guarantees that come with your policy. Now, the non-guaranteed scale is simply showing the amount of growth that's expected to occur in your account. The way life insurance works is with a company like this, that's a mutual participating company, is all the different policyholders pool their funds together into one big pot. And then the company takes that money and it's able to use that money and grow that money at a very conservative rate, using very conservative types of growth assets such as corporate bonds and real estate and all sorts of different other options, even banking functions. And these conservative methods have been proven and have worked for literally centuries now, and they can generate a return within that 3 to 6% range. So we're not talking about 10, 15, 20% type of investment growth. We're talking about a very safe, conservative number that these companies are able to do. And what that does is it allows our cash to grow within our policy. And we get to reap the rewards of that growth. You see, as mutual policyholders, we get to take part in the dividends from the company. And the dividends that we receive are tax-free according to the IRS, because the IRS considers them a return of premium. So, essentially, we're getting conservative tax-free growth in our life insurance policy. And so what you will see here is an estimate of what that growth will be. And the current scale will simply show what dividends and growth rate we're seeing, and the midpoint would be kind of a halfway between no growth and what we currently see. So it kind of gives you an idea of if we're performing as expected, we should see the current scale. If we're performing less than expected, you could probably expect the midpoint scale. And this column here shows the absolute contractual guarantee. The problem with some of the other types of investments like IULs is that you'll see that they have very few guarantees associated with their policies. So when I'm putting my life on the line, I want guarantees as a part of my policy. Okay. So now that we can see that you'll also see by age 70, John Smith has put in $204,000 of premiums in. He still has $500,000 of death benefit, but if you look over here, you're going to see the death benefit says $681,000. So it's grown by 181,000 by age 70. And the reason is because this is taking into account the projected growth in dividends that will occur in his policy. So he would expect to see his death benefit grow. You can also see the amount of cash value that he has access to. So he should have access to $239,000, but you'll also see over here, because of the expected growth, they would expect him to have access to $356,000. Now that we've looked at that, we can move along and look at a few other details of this type of just a regular whole life policy. And what you'll see is that every year he's paying $5,835. And in the first year, he's got zero cash value and $500,000 worth of coverage. And he's going to continue to pay that premium year after year after year. And he's going to start to accumulate cash value that he can use as an emergency fund if he needs to. And eventually, what you'll see is on the contractual guarantee, he's guaranteed to have that $500,000 worth of coverage, no matter what. But over here with the expected growth table, you'll see that his death benefit will continue to grow. So let's go ahead and follow that out. And then by the time he's 71 years old, we're seeing a projected cash value of $376,000 and a death benefit of $692. So let's go down here to, let's say, age 85. Let's say that John passes away at age 85. Well, he's projected to have $892,000 to pass down to his beneficiaries tax-free. That's a great benefit. That's a way to pass down generational wealth. And this is just with a plain Jane whole life policy, not a customized plan. And you'll see that we can do much better than this. So if you look at the very end here, let's say that John lived 121 years old. And his total premiums that he put in over the course of this time was $501,810. So his coverage contractually is $500,000. So over the course of 121 years, with the course of several years to get up to age 121, 86 years, he's put in this much, $501,000. And he's contractually guaranteed $500,000 of death benefit, but his death benefit is projected to grow to $1,931,000. So essentially quadrupling what he's put into this policy, all the while having access to these funds should he need him. So this even replaces his emergency fund. And there are so many other aspects that we'll talk about later, but this is just to show you how a basic whole life policy works. Now, often people will say, buy term insurance and invest the difference. So I want to address this here shortly, because you may say, well, if I just bought term for 30 years and invested the difference, I should get a lot more return by putting my money in the stock market. People say I can make 12% in the stock market or more. This is common advice given to many folks without taking several things into consideration, including a risk tolerance, a person's financial personality, and planning for emergencies. It's built on a grand assumption that the market will perform consistently over the next 30 to 50 years, and that a person will have accumulated enough money in the market to self-insure at their retirement age. So a 12% average rate of return is often quoted as a reliable metric, when in reality, returns in the market are around 6.5% when you take into account taxes, fees, and the ups and downs of the market over time. Now, I've done a video that goes in depth on this particular topic, and I traced out the S&P 500 over the last 40 years and actually showed what would have happened if you had invested $100 a month over that entire course of time. And this is what I found. This whole 12% idea is a complete fabrication. It's a myth. It's designed to sell it's designed to sell investments and not necessarily to tell the straight truth. So when somebody says a 12% average rate of return, you're really looking about 6.5%. And you've introduced risk. So even worse, you've exposed the majority of your cash to possible devastating losses in the market, especially if you need to withdraw during a severe down market. Not only that, but all this cash may be tied up in accounts that don't give you access to it without large penalties. So if you need the money for a great opportunity that presents itself, such as real estate or a new business or even an emergency, you don't have access to it. And meanwhile, the government is getting a free ride on your portfolio because they will receive a huge chunk of your investment in the form of taxes. Government loves this. By the way, most people who accept the buy term and invest the difference strategy don't actually invest the difference. They end up spending the difference. And that, my friends, is dangerous. That's dangerous advice to give to people. Term insurance is great when you're young, but remember, when you get older, it gets astronomically expensive. So it's better to have convertible term you can convert into permanent insurance that retains its permanent cash value. So consider that, first of all, when you think of buy term insurance and invest the difference. Definitely want to have that convertible term. Now, investing in the market is certainly not off limits, and I'm not suggesting that anyone does or does not invest in the market. I personally place a high priority on securing financial coverage for my family before introducing risk, much less basing my financial security on a product with inherent risk. So the question is, do you want to base your financial security on something with inherent risk? Or do you want to base your financial security on something with contractual guarantees? Because once you've established your financial foundation and contractually guaranteed your coverage, then you can take money and invest it in riskier investments, and that's fine. My personal preference is to develop that foundation first and then branch out into riskier investments that may have higher return on reward. So let's review those term costs now that we have an understanding of how whole life works. If you remember, term costs for John Smith at age 35 looking pretty good. And as he gets a little older, let's say he wants to buy term, it starts to get much more expensive and not guaranteed at all to continue. So wouldn't it be nice if we could combine just the right amount of term with whole life so that we get the best of both worlds? Sure would, because the best policy is usually a blend of term, whole life, and paid-up additions. Now I'm going to explain what paid-up additions are here in just a moment. The term gives you max coverage and can be set up to convert to whole life automatically or at will, which means you can take your term coverage and say, I want this to convert over to whole life every year so that when I'm done with that term for the year, I'm going to convert it over. Or you can have it done at will. You can say, I'm going to keep on the term for a while. I don't have enough money to convert it over. I can't afford to convert that to whole life, so I'm going to wait, but I have the option to do so in the future. So now, whole life builds up to cover you when term is no longer available and serves as a cash reserve. Paid-up additions buy additional insurance as a one-time purchase. But they can also be used to convert term to whole life and keep your term costs very low. So paid-up additions is buying insurance as a one-time purchase, where like a whole life policy is buying a large amount of insurance with premiums spread out over a specified time period, like let's say 121 years or 95 years or age 95, or spread out to age 70. Paid-up addition is purchased immediately. It's a one-time purchase of a smaller amount of insurance, but as a one-time purchase. And in your policy, you can dictate that you want that paid-up addition to convert some of your term coverage over to whole life, and that will help keep your term cost even lower. We'll look at how this works in an actual policy. But first, what if I can't afford whole life? Well, number one, buy convertible term. And number two, as you're able, convert portions of it to whole life. And number three, treat that like your emergency fund. A lot of people have developed an emergency fund, and they're simply putting their money in a bank account. Well, what if you could put your money in a bank account that generates tax-free interest in the 3 to 5% range and buys you death benefit, buys you insurance? Well, then you would be doing three things with your dollar. You'd be storing it as a cash reserve, you'd be purchasing interest, and you'd be growing it tax-free or tax-advantaged. So if it's set up correctly, you can take advantage of all these awesome ways to use your dollar. So think of it this way. You've got a rocket trying to get to space. Term insurance is going to cover you in the short. It's going to be like a parachute to cover an early loss. Now, I know that rocket ships don't necessarily have parachutes to save you. I mean, if the rocket blows up, it blows up. But stick with me here. No analogy is perfect. So term insurance would act as a parachute to cover you in the early phases of your policy in case you had a loss. In case you died early, you're covered. That's great. It's cheap. You definitely need it as a part of your policy. Now, the paid-up addition is like a booster rocket to get you to high orbit. And those booster rockets eventually fall off. You don't purchase paid-up additions for the entirety of your life. If it's designed correctly, you're going to have paid-up additions weighted towards the very beginning of your policy to get it moving fast, to get your policy to become more efficient very quickly. And then your base part of your policy is simply that base premium you're paying for whole life, like we looked at earlier. This is the shuttle that sustains you for the long haul. It sustains you for the entire journey. And all three of these things are an important piece of the puzzle. So let's take a look at an example of a whole life policy with term coverage blended in. And what you'll see here is here's the base policy covering you, giving you $300,000. So in total, you're going to have $500,000 of coverage. $300,000 of that is coming from your base premiums that you're paying in, $3,606 a year. For now, don't worry about these riders. We'll explain these later. We'll go into that. I'll touch on that. But take a look here. Here's your term coverage. Now, this has a fancy name to it, Enhanced Blended Insurance Rider. We call it EBIR. But what this essentially does is it gives you $200,000 worth of term coverage. Now, you'll see here that it costs $0. Now, why would $200,000 of term cost me $0? Well, because I'm paying for that term with my paid-up additions. So this paid-up additions rider allows me to contribute up to $3,000 a year in one-time purchased insurance. And I can opt for my policy to automatically use that money to convert this $200,000 in to permanent policy over time. Now, it's not going to convert all of it at once, but it's going to convert some of it so that each year I'm converting a little bit at a time until when I get to the end of that term, let's say I set that term for 20 years, and I get to that end of that 20-year mark, I've successfully converted all of that term over into whole life incrementally so that I could afford it, right? So it gives me the best of both worlds. Now, paid-up additions riders also do other things as well, but essentially, it purchases your term and converts a portion of it each year to permanent insurance. It also adds to your cash value. So let's take a look here. Again, $500,000 worth of total coverage starting at age 35, and we're paying into age 121. So what you'll see is that by age 70, we've paid in $171,210, and his death benefit is already 3.5 times what he's put in, $606,000. His cash value is essentially double what he's put in. So he has access to all this cash by age 70. He's got $606,000 of net death benefit, so a 3.5x on what we've put in, all with contractual guarantees so that we remain covered. So let's break this down, and we can see year by year. Here's an interesting thing to look at, is that by year 15 on this policy, the way it's designed, the paid-up additions are no longer active. And so our contract premium goes down to solely the base amount. So that's why you'll see it actually gets less expensive at year 16 by the time he's 51. And by that point, he's already built up a decent amount of cash value, $107,000 of cash value. And if we look a little bit further down into the future, let's say we get to year 21 now, or age 56. Now we're going to see this column here goes to 0. So this right here, OYT death benefit, this column shows your 1-year term. And so each year you're purchasing that $200,000 worth of term that was in that EBIR that we talked about earlier. However, a portion of that is being purchased through your paid up additions. So again, that money that's going to the paid up additions every year, that $3,000, just bought you $11,980 worth of permanent insurance. And so we've already converted $11,980 of that $200,000 on your first year by using that $3,000 worth of PUA. Now, the second year, we're going to put another $3,000 worth of PUA in, and now you're going to see we've converted $23,707 of that $200,000, and so now you'll see that that term looks even less. Now we have $176,000 worth of term coverage, $23,000 more of that permanent coverage through our PUA. All the while, our base is just going. That's that shuttle that we're keeping for the long haul, that $3,606. We're paying that every year. We're paying the extra $3,000 up to year 15 for our PUA so that it's slowly converting a little bit more and more of this every year, okay? And so that by the time we get to year 20, we have converted all of our term coverage into whole life coverage. And so now you'll see, now that that term is run out and we're no longer using it anymore, now we start to see a growth in our death benefit. Now, why don't we see growth for these first 20 years? Well, because we've only purchased $300,000 worth of base death benefit. You see, right here, here's a $300,000, and this $11,980 is coming from the PUA portion of it. So that's why, if we did not have this $200,000 worth of term, our death benefit would only be $300,000 based on our base, and another $11,980 based on our PUA. So because we have term, we're covered all the way up to $500,000 until that 20-year term runs out here. And what that allows us to do is then we're able to have more coverage in the short term in order to level out so that by the time that term is all converted over, now we still have that $500,000 worth of coverage, and we're going to start growing and building on it. So now from age 55 up, it's all growth in that death benefit column. So let's follow that through and see, and you'll see that by the time we get to age 85, we've got $779,000 worth. Okay, so now again, this non-guaranteed column is giving us our projected growth. So it's showing us what's likely going to happen as our policy continues to grow. And again, this is our guaranteed column. This guaranteed column can't guarantee that it can't demonstrate the growth that we'll see in our policy, but we should expect to see this amount of growth. Any reasonable estimate would agree with that. And so that by the time we're most likely not going to live to 121 years, but let's just for the sake of comparison, let's go out to age 121 and see, wow, our cash value has grown so much. It's actually more than our death benefit. And the total premium that we've paid throughout this entire time is $369,000. So we've just, let's just say this is $400,000, 8, 12, 13, we have about 4 or 5x our money just from doing this, all the while having protection the entire time, and having access to our money. So not $1 of our money was wasted. Not $1 was thrown away. We've kept it all. In fact, we've multiplied it. And this is essentially how you pay zero for life insurance, and the idea of you don't lose. You don't lose with this. But we can do even better. So I hope you're sticking with me. Maybe you need a second to grab a drink, a cup of coffee, something to keep your brain in the game. But this gets even better as we custom design this. And I'm going to introduce you to a concept known as infinite banking. So infinite banking is the idea of becoming your own bank and building generational wealth with this particular style of policy known as an infinite banking policy. What is infinite banking? Infinite banking is a financial strategy that involves using a specially designed whole life insurance policy as a personal banking system. It allows individuals to build up cash value in their policy over time, which they can then borrow against for various expenses. The idea is to become your own bank and have control over your own money rather than relying on traditional banks or lenders for loans. This approach can provide benefits such as tax-free growth, asset protection, and the ability to earn interest on your own money. Infinite banking is a conservative and safe method of wealth accumulation that has been used for decades. So, why have specially designed whole life insurance? Well, a life insurance policy can be specially designed and tailored to your specific goals and needs. It can be designed to function as an infinite banking style policy, which essentially creates your personal family banking system. Infinite banking is sort of a catchphrase or marketing term, but essentially it refers to you becoming your own banker. An infinite banking or IBC policy or strategy is not like a stock market investment. It's not designed to be used for everyday transactions like grocery shopping and rent. It will not get you rich. Think of it more as a very stable place to store your cash with tons of side benefits. A properly designed policy lowers your financial risk. Anyone introducing more risk into the equation is not selling you an IBC, infinite banking concept policy. So why have specially designed whole life insurance? Maybe because you want an asset that you own and control outside the stock market, a 401k, an IRA, a TSP, or any other government-sponsored retirement plan. Maybe you want complete control over money that you borrow for things like vehicles, vacations, business expansion, or education. Maybe you want creditor protection built in case you get sued, and you want privacy from the IRS and other outside institutions. Maybe you want to leverage your cash value to fund other potential high-risk or high-reward investments. And perhaps it's because you want to create a financial tailwind in all the activities that you participate in. So by having specially designed whole life insurance, it becomes an asset that works for you. And this is where we can talk a little bit about uninterrupted compounding interest. So compound interest is when interest growth accumulates and accrues, and then you earn interest on your interest. And when it's uninterrupted, it creates exponential growth. And this is what happens in your policy. This is what we saw earlier, as your policy continues to grow and grow and grow and exponentially grow upon itself. And with exponential growth, the sooner you start, the better. That's why a child, if they start their policy when they're really young, we looked at John at age 35, and by the time, he was in his 80s, he was close to a millionaire after just a policy like that. So now, if you start when you're very young, imagine the type of growth that you could see even with a modest amount of coverage. So that's how this uninterrupted growth creates exponential growth. Most people never reach this in the pay with cash model because they're constantly depleting and replenishing their capital rather than letting it compound. But infinite banking allows you to benefit from uninterrupted compound interest while financing your other investments. You see, when you take a policy loan from your cash value, and I should say against your cash value, because a policy loan is a loan with the insurance company. So essentially what you're doing is you're taking a policy loan using your cash value of your policy as collateral against that loan, which means your cash value in your policy is actually never touched. It continues to grow interest, compounding interest the entire time. Now, there is a interest charge for your policy loan, and usually that interest is very close to the growth rate on your policy. So essentially, let's say that you have $100,000 in cash value that's constantly growing and accumulating more compounding interest over time, and you want to take a $20,000 policy loan, and your policy growth is 4% tax-free, and your policy loan is 4.5% interest. Well, you're going to have to pay 4.5% interest on your policy loan of that $20,000 while gaining 4% growth on $100,000. So you're continuing to compound your growth even if you take a policy loan out. Now, you would simply pay your policy loan back just like you would any other loan. So, but rather than having to go to the car company and the lot and have them finance your vehicle and pay them amortization and interest and finance charges, now you're doing it through your policy that you have complete control of. So you're just funneling that payment back to you so that you're able to keep more of what you're putting into the system instead of giving the advantage to other banking institutions. You've become your own bank essentially by working through a mutual company. And this is another way that you can generate wealth for the next generation. So generational wealth includes financial assets such as property, investments, savings, education, and social networks. So we want to learn how to provide long-term financial security and stability for future generations of your family, and we can do this with life insurance, specifically infinite banking style policies. You can give your children and grandchildren the best start on life and teach them these concepts now. So here's the foundation. Number one, replace your income in the event of your passing. That's just what we've just been talking about. Number two, serve as the most effective cash storage for wealth accumulation. So your policy will be this cash storage place that you can accumulate that wealth. And number three, it can provide a private banking function for your family. So now if your child needs a vehicle when they're 20 years old, you can take a policy loan out and they can pay you back for it. You can be the bank for them, and you can set the terms. You can set how they're going to pay you back, however you decide is right, rather than them being dependent upon the bank to do so. Or let's say it's for an education or for a first house or whatever it may be, and you can have them use their own policy for this that you started for them when they were very young. And it teaches them the concepts of generational wealth building. So not all life insurance is the same, as we've talked about. A properly structured policy based on the infinite banking concept is designed for effective generational wealth accumulation. And there are required components. It needs to be a mutual company. A mutual company is mutually owned by policyholders. So the company's responsibility is to the policyholder. Now, a stock company is owned by stockholders or shareholders. And so the company's fiduciary responsibility is not to your policy owner, but to the shareholders. So it's important to be working with a mutual company where you're placed first. Now, it needs to have a Comdex score over 90. A Comdex is just a rating by independent agencies that shows how healthy and how stable the company is. It needs to be dividend paying whole life, not any sort of variable or universal. It needs to be paying dividends back to you, which grow tax-free. It needs to be overfunded with paid-up additions, meaning you're using those booster rockets to overfund your policy early in the future so that you get up to high speed, you get up to orbit real fast, your policy gets very efficient. And then you need to add in the term coverage as needed with convertibility option to cover all your bases and allow you to grow this policy the way you see fit. But be sure to only work with an agent, this is important, that has experience in the proper design of an IBC policy. Don't try to create one if it's being designed by someone who's never heard of it or has not been trained in creating an IBC policy. There are a lot of people out there that are claiming to build you IBCs, and they're using it with IULs, Indexed Universal Life, and that is not designed for that. There is a high chance it will crash and burn. So do not try to build an IBC policy with an IUL, VUL, or UL, anything other than a whole life policy with term blended in. And don't try to do it if it does not include a paid-up additions rider. If your agent is not giving you a PUA rider with paid-up additions in your policy, then they're not setting up an infinite banking style policy. So let's you and I create an infinite banking policy for John Smith right now. First of all, here's what we're going to look at. Number one, instead of being paid up to age 70, we're going to pay this premium up fully at age 70, which means, instead of being paid up at 121, we're going to pay it up at 70, which means that by the time he's 70 years old, he's paying no more payments into his policy. We're going to get this done fast. We're going to get it done even faster by throwing in $10,000 when he first starts, because John has got $10,000 sitting in his bank, or he's got $10,000 in a bond, right, or a CD that he's been holding on to for several years that's barely growing, and he's going to put this into his policy instead. So he's going to start us off with $10,000. He's going to have a base policy that gives him $300,000 worth of coverage that's cost him $4,638 a year. Okay, so here's his shuttle that's there for the long haul until he's age 70. And then he's going to add in $5,500 a year of paid-up additions. And this is going to automatically convert $350,000 worth of term coverage. Now that $350 plus the $300 is what gets him to the $650,000 in total. So he's going to start to convert this over a set number of years. And again, he's going to start us off with a $10,000 first year dump in. So let's take a look at how this works out. Year one, he's put in a total of $20,000, $20,138. And he's going to have this straight death benefit of $650,000. But look, he's already got $15,000 worth of cash value, which means that if he had a vehicle payment that he was paying for, now he can immediately do a policy loan, and instead of paying the amortization schedule for his vehicle and the high interest rate that he could be paying on it and potential finance charges that he's also paying for it, he's simply using his own policy loan to purchase that vehicle, and he can decide how he desires to pay that back, at what type of amortization schedule he desires to do at his own rate. Now, we get to year four, and look, he's already grown to $43,959 of cash value that he's able to use. And at this point, he's converted quite a bit of that $300,000 death benefit into permanent coverage. You can see he's converted $125,000 of it over. So he's chipping away at that 1 year term. He's chipping away at that $300,000 of term known as EBIR till it's eventually all converted off by year 15, you can see. So again, let's go back to this $43,000. Well, maybe he wants to take another policy loan out, because by this point maybe he's paid this one off, or maybe he hasn't and he just wants to use a portion of his cash value here to pay for his child's education, right? And perhaps by year 9, he's got this $100,000 of total cash value, and he wants to purchase an investment property with that and instantly turn his cash value he has access to into an income-generating asset that then brings him more income. And this is why we call this infinite banking, because you become your own bank. You start to utilize this system to be able to fuel and add tailwind to other types of activities that you're doing with your finances, whether it's starting a business or buying a property that you're then renting out, and you're actually making a multiple of what you're paying in interest for that loan that you're paying. So you're going to be paying yourself back into your policy and eventually continuing to grow this cash value and your death benefit. Now if we continue to follow this along, you see that the PUAs were only set up into year 15. So the PUAs have completely purchased all of the term benefits. So at this point now, you are no longer paying PUAs, and you no longer have to have the term. And so at this point here, you're just paying your base, and your policy is growing because it's become efficient very fast. It's reached high orbit. And so now it's just running on the momentum and inertia that's already been generated. And so at this point, you're just going to see that total net death benefit column continuing to grow and grow and grow and grow. So let's take a look and see what this looks like in a few years. Now remember, we talked about how this was paid up at 70. So at policy year 36, age 71, he's no longer paying anything into his insurance policy. He's done paying. So if you want to retire at age 70 and you want to say you want to be done paying any insurance at that point, you can choose that option. Now, why would you though? Because this is such a tool that you could use this to continue to grow, or even take out other policies if you're able to financially at that point, to continue to fuel your whole financial tailwind. However, at this point, he's done paying completely. And so he just sees his cash value continue to grow. So now let's say he wants to buy 2 or 3 investment properties with a policy loan. He has the option to do that. And his total net death benefit. So by the time, let's say he's 85 years old, he's got $1 million worth in total net death benefit. Now let's say that he owns 6 properties at this point, and he's got $500,000 in death benefit in a policy loan that's still outstanding. Well, if he dies and he's got $500,000 worth of policy loan outstanding, then his death benefit will simply pay for that policy loan, the $500,000. So essentially, he'll receive $598,000. I'm sorry, his beneficiary will receive $598,000 tax free. Okay, so that just goes to show that even if you don't pay off your loans completely, they're simply deducted from your total death benefit. So it protects you. It gives you the freedom to be able to say, yeah, I'm gonna invest in this here and there, because at the end of the day, I'm still going to be covered. And just for comparison's sake, let's say we did live to age 121. And here you can see total net death benefit, $2,222,000. Right? And cumulative premium by the time we fully paid for our policy was $254,830. That means we've 8.75x'd our premiums by the year 121. So that's why this becomes an effective method to turn your dollar and make it do 3, 4, 5 things all at once and fuel all your financial endeavors. And that's why I'm a proponent of infinite banking. But if this scares you a little bit, you can remember that the cost of insurance is flexible, because your premiums can be set up as a range rather than a set number. So with PUA, it gives you the option of purchasing additional insurance. It doesn't force you to purchase additional insurance. So you're able to give yourself some wiggle room. If one year you've done really well that year, you came into some money, you can max out your PUA. And then perhaps the next year you had a larger tax burden, or something comes up and you do not want to pay as much PUA, then don't pay any PUA and simply pay your base premium. So it gives you a range. And in this case, we'll go back up and we'll see what that range was. Let's say, so total $10,138. Well, maybe one year he wants to pay the entire $10,138. And the next year, instead of paying PUA and base, John just wants to pay $4,638 that year. He's totally able to do that. So this way, in good years, you can pay the max to build up your cash value and coverage. And in tough years, you can pay the minimum to give you some wiggle room. So you may be asking yourself the question, how do I practically make this new paradigm work for my personal financial situation? First, we start with financial foundations. Number 1, budget. Create an ideal budget. So this is a spreadsheet of how you would ideally like to allocate your income. And you would include what you would like to set aside for savings. Then you create a realistic budget to compare it to. And this is a record of how you actually spent your income over the last couple of months. Then you can analyze where you need to restrict your spending in order to achieve your ideal budget. Once you have your ideal budget worked out, then you can determine how much life insurance to purchase or to fund. So imagine that you have a machine in your basement that prints money equivalent to your yearly income. How much would you insure it for? you'd want to insure it for its entire lifetime value. So an easy way to think of this is to multiply your yearly income by the number of years until retirement or until you plan to be independent of active income. A general rule is to take your income times 30 years. So let's say that you're 30 years old and you want to retire at 60 years old. Well, take your current income and multiply that by 30, and that's a general estimate of how much life insurance you may want. Now, for some people this may be too little, and for some people this may be too much. So you're going to want to choose an amount that you feel comfortable and confident with. You don't want to overextend yourself in purchasing life insurance, but you also don't want to cut yourself short and not have enough coverage. You also don't want to cut yourself short and not properly funding an infinite banking style policy, because funding it is a very important part of it. You're not throwing away your money, remember that, but also remember not to overextend yourself. There's always room for creating more policies in the future as you come into more money. So number 3 is to create that efficient emergency fund. And in this way, you're actually using your life insurance policy as an emergency fund. So for a lot of people, they can simply take the money in their emergency fund and use it to fund their life insurance policy, because now it's replacing their emergency fund. And it becomes very efficient because you're using your dollar in more than one place. But for starters, you need to have $1,000 ready to use in case of any sort of small emergency. Or an unused credit card can serve as your emergency fund or as a backup. Think about it. Any emergency expense that you encounter can usually be covered easily by a credit card. And then you can pay yourself back. You can pay your credit card off with their policy loan within 3 days. So as soon as you get your policy loan money, you can pay that credit card back off. But for your emergency fund, you need to work to build up to 3 to 6 months of living expenses. Some people even say up to a year or more. But a good rule of thumb is to shoot for 3 to 6 months, so that if you were to encounter an emergency where you couldn't work or something of that nature, you could be able to replace your income and pay for your living expenses. Now, a high-interest savings account can be used temporarily until your specially designed whole life policy is established. And then you will then want to focus on building up your policy cash value. And this is your permanent emergency fund or efficient emergency fund. To start us off, you might want to consider moving volatile investments like stocks and bonds into your efficient emergency fund. And finally, number 4 is cash flow. You want to start generating that cash flow so you create more momentum. So you can use something like a debt avalanche method or a cash flow index method to begin strategically paying off liabilities. So a debt avalanche method is simply paying off the highest interest rate loan first. And a cash flow index is a little bit different, and I have separate teachings on that. But to clarify, you're going to want to start using a method to strategically pay off these liabilities. And I say liabilities specifically because debt can be good and it can be bad. For example, luxury is typically bad debt, a really expensive car or something you don't need, whereas an investment property would be potentially very good debt because you may owe on the investment property, but the amount of cash flow that property is bringing in is enough to pay off the mortgage and bring you income on top of that. So in that case, it's not a liability, it's an asset. So when you focus on paying down your debt, you don't necessarily want to focus on just paying down every loan you have as fast as possible. You want to strategically pay down the most volatile and aggressive and harmful liabilities that you have first and chip away at them strategically. You can also consider options for refinancing or consolidating. A policy loan from your infinite banking policy can be a great option. Simply consolidating some of that really high interest debt from your liabilities into a policy loan can reduce your interest rate and give you the freedom to pay off that more wisely and more safely. And so now you're creating a financial tailwind that will propel your financial endeavors and your investments and everything that you do. Let me give you an example of how to beat amortization with a simple policy loan. Amortization is the process of gradually paying off a debt or a loan over a set period of time through a series of regular payments. And these payments typically consist of both principal and interest. Principal is the original amount borrowed, and interest is the cost of borrowing. The payments are structured as installments so that the borrower pays off more interest in the early years of the loan and more principal in the latter years until the entire debt is paid off. Amortization is commonly used for mortgages, car loans, and other types of installment loans. So a borrower will make the same payment each month until the loan is fully paid off and have little to no control over modifying this amount. Here's an example. Let's say you take a $30,000 loan at 6% interest for a vehicle. Now, the average today is currently 6.58% for new cars and 11.17% for used. And of course, this is all dependent upon your credit score. However, these are the averages. So your car payment, let's just give it a very beneficial rate compared to the average. Let's say it's 6%. Amortized over 72 months would be $497.19 a month, totaling $35,797. So your total interest paid over the course of that 72 months is $5,797.44. That's quite a bit of interest. And don't forget, a lot of times they'll sneak in finance charges. For example, you could have a finance charge that's just as much as your interest rate, essentially doubling your interest rate, but they don't have to claim that that's the interest rate because it's considered a finance charge. So be aware of that. Now, how does an infinite banking policy loan beat this? Well, first of all, you can simply reduce the interest rate, going from 6% to 4.7% on your policy loan. Now, the policy loan interest rate will change every year by a small amount, and it will be declared at the beginning of that period. However, it's usually very, very close to the growth rate in your policy. So it's very, very competitive with typical interest rates out there. I'm going to tell you right now, my current interest rate of 4.75% certainly beats the average of 11% for a used car right now. So using the same amortization schedule, you pay significantly less. The interest you paid would be $4,486, which would save you $1,310 simply from moving your vehicle loan from a bank into your own personal bank in your infinite banking policy. You've saved yourself $1,300 worth of interest, and you get to set your own schedule so that in months when you want to pay more, you can pay more. In months when you want to pay less, you can pay less. Totally up to you how you do that. Oh, and by the way, your car is fully paid for. You have the title to the car and no one can take it from you. Because your policy loan is a secured loan. It's secured by your policy. So it's not secured by the car anymore. It's secured by your policy. And that's also why you don't have to go through any sort of application or qualification process to take out your money, to take a loan from your own policy. It's very simple. But there's more. You can choose to pay more some months and less others, as I said. So let's imagine that you came across an amazing business deal that would immediately generate 100% return on income, but you couldn't capitalize on it because you were tied up with car and possibly other loan payments. With the infinite banking concept, you have control to pause those loan payments and take advantage of such opportunities that bring you more income. Let's say that you found a great rental property and you paused your payments to your other loans in order to purchase this rental property that's bringing you an immense amount of return on your investment that's enough to pay for the loan itself and bring you more income. And now that you're able to use your infinite banking, you're able to take advantage of that, whereas before you might have felt stuck. And don't forget that this entire time, even during using your policy loan, you're earning tax-free growth, even on the amount borrowed against with your policy loan. So before I talk about riders, which is very important in the last section of this presentation, I want to mention another aspect of this, which is that Let's say you want to use your own banking policy to fund your child's education or purchase their vehicle, right? You can actually take out a policy loan and have your child pay you back for it. Let's say your child wants to go to school and they want to get grant money for education. The school has no right to access information about your policy. And what this means is that the amount of money that you have in your policy doesn't affect your ability to get a grant or financial aid, whereas putting your money in other places can affect your ability to get those financial aids or grant monies. So placing money into an infinite banking policy for a child or a grandchild is a great option. Now let's talk a little bit about riders. How can I withdraw cash from my policy tax-free in retirement? Well, as you know, if set up properly, the growth in your policy is tax advantaged, means that once you've put that money in, it will continue to compound interest and grow tax-free. So you can withdraw from your cash value in your policy tax-free as long as you don't withdraw more than the total amount of the premiums you have paid thus far. By doing this, however, your beneficiaries will receive a reduced payout when you die. And there can be some times when this is appropriate, but in general, it's better to take a policy loan. The policy loan is not taxed. Now, there is interest charged on a policy loan, and in retirement, this is where a LILR rider becomes very helpful. A LILR rider is a loan interest limitation rider, and it essentially guarantees that your policy cannot lapse due to unpaid loan interest. It provides under certain conditions that interest on any policy loan will not exceed the growth of the cash value of the policy. This means that your interest rate on your policy loan cannot grow to exceed your cash value and therefore lapse your policy. So by taking a policy loan in retirement with a LILR rider, there's no risk of your policy lapsing and you losing it. It's very helpful when you're looking to take some income during retirement or create a buffer between you and your other retirement incomes. Let's say, for example, that you had an IRA or a 401k that was made available at age 59 and a half, and it just so happens that the market is down 10% that year, and perhaps you don't want to take money out of that fund that year. Well, perhaps you'll just take a policy loan to provide for your living expenses, and then in a year or two later, then maybe you could dip into that retirement account as the market's gone up 10 or 15%, and it's an advantageous time to do so. And then using that money, you could pay back your policy loan if you so desired. The point is that it gives you a volatility buffer in retirement, so that when the market's ups and downs have their ebb and flow, you're able to use this to ride those waves very smoothly. Now, there are conditions. Your policy needs to be paid up. It needs to be in force at least 15 years. You need to have attained age 75. And the loan balance has to exceed or equal the year-end cash value. And the policy can't be a modified endowment contract. Now, a modified endowment contract is simply a way of saying that the policy has become taxable. And by working with an agent that sets this up properly, this will never be an issue for you. That's why it's important to make sure that your policy is designed and maintained correctly. Now, let's talk about your children. You can get a rider that provides $20,000 of death benefit on the life of each child of the insured between the ages of 14 days and under the age of 20 years who are named in the application. So it could be 14 days old or under 20 years, and they could be covered under this children's insurance benefit. Now, that children's insurance benefit can also be changed into a whole life policy for that child when they become of age. So a waiver of premium for disability is another optional rider that you can have that this one is a fee for as well. And so a waiver of premium for disability will cover you if you become disabled. So your policy premiums are waived if you become totally disabled for 6 consecutive months. Your cash value will continue to increase the same as a premium paying policy. This is very important for people to have because should you become permanently disabled, this will cover all your premiums and you can still guarantee that you're covered. This one comes free with a policy at One America, which is a terminal illness rider. And this one, you receive a portion of the policy's death benefit if you're diagnosed with a terminal illness with a life expectancy of 12 months or less. So essentially, you get to access more of that money to help pay for the cost of your expenses with a terminal illness. A similar one that also comes free is a chronic illness rider. And in this one, you receive a portion of the policy's death benefit when certified as chronically ill. So congratulations. Now you have a solid grasp on how to successfully make life insurance an asset that works for you. For more information or to get started, please contact me at daniel@mpgwealth.com. And you can also find Protos Wealth Concepts on Facebook and Instagram. And I want to leave you with this. When you're thinking about life insurance, always think long term. And remember to think about your children and your grandchildren as well. Because what you're creating now is not just life insurance, but it's a legacy. It's a legacy that you can hand down from generation to generation. Thank you very much.